One of this morning's key earnings reports I want to talk about Warner Brothers Discovery. Take a look at what is going on with that stock this morning. Going to get out to Julia Borston on the West Coast with an update on that company. Julia?
Well, Andrew, it was a mixed quarter when it came to the earnings, but the company is making progress with its debt load, and that is what's pushing the stock up nearly 5% higher pre-market. Now, the stock getting a boost from the announcement of a tender offer to pay down up to $2.7 billion in debt. CEO David Zaslav kicking off the call with this news, noting that they have already paid off $9 billion in debt since that company's merger. Now, the strength in the quarter was in its free cash flow. It came in at $1.7 billion. Notably, that's nearly $1 billion more than the year earlier quarter. It's also ahead of analyst projections of $886 million. Now, the company says they expect to have that same $1.7 billion free cash flow in that same range in the third quarter. Also, its adjusted EBITDA, $2.15 billion, did beat expectations of $1.98 billion. The company's revenues, though, $10.36 billion, fell short of expectations. The direct-to-consumer subscriber number, 95.8 million, missed estimates and also fell nearly 2 million from the end of the first quarter amid the rebrand and combination of the streaming service into the new Max streaming offer. But on the upside, the losses of the streaming division were less than anticipated, $3 million, pretty much flat compared to expectations of a nearly $300 million loss. David Zaslav saying on the call, which is undergoing right now, that the transition to Max has gone exceedingly well with lower than expected churn. He also noted early signs of stronger engagement. He also said, and this is interesting here, that they have the capability to deliver live programming. And then he said they see opportunity in the streaming space for sports. So maybe some competition there for ESPN+. He also mentioned the potential around their video game business, saying that's a real differentiator for Warner Brothers Discovery as a media business. Andrew?
So, Julia, and by the way, it's nice to see you in New York, but I was going to say free cash flow, that's the holy grail in the media business at the moment. There's very few other companies, by the way, sort of pure plays that are having that right now. My question on the sports piece was, is your sense that when it comes to the NBA contract, for example, and some of the other deals that they're making, that they would then put that onto this platform, and that's how they would make the economics of it work? And would that work?
Well, look, Turner obviously and the Warner Brothers Discovery assets obviously have a lot of these sports rights, and Turner obviously has the relationship with the NBA. The NBA, those are the next big rounds of rights negotiations that are on the table. I think what he's noting is that if they wanted to bring some streaming rights, if they had the capability from a rights perspective to bring some of those streaming games over to their new Max platform, they could. The question now is what's going to make these streaming platforms really competitive, right? So if everyone's rebundling and you're combining the Discovery assets in with the HBO assets into this new Max platform, what's going to, and we see, by the way, the same thing happening with Disney as they talk about folding in Hulu assets into the Disney Plus app. What's going to make it even more compelling? Everyone obviously really cares about sports. So maybe he's hinting that when they're doing their next round of negotiations, they're going to have the flexibility in there to stream sports as well as offering it on linear TV, which seems to be what ESPN is looking at as well.